All right, so are you ready to like really dive deep into the stock market?
I am. I am.
Today we're looking at How to Make Money in Stocks by William O'Neill.
Oh, yeah.
It's one of those books that I think, you hear a lot of people talking about it like for a reason, right? It's kind of considered like a classic
Well,
in the world of investing books. And it's really targeted, I think, to just like the everyday person
absolutely.
who wants to learn how to invest.
It's very accessible.
Yeah.
And that's, I think, what makes it so powerful is that it really does break things down in a way that anybody can understand.
And I think what I really like about O'Neill's approach is that he's all about data. He's not about like hunches or, gut feelings or, tips from your uncle or whatever.
It's all about a system.
Yeah.
It's a very systematic approach.
And I think that's really appealing to a lot of people because it takes the emotion out of it. It's like, okay, here are the factors. Here's what we're looking for.
And it's repeatable.
Yeah.
Like you can do this over and over again.
Right.
It's not just a one-time lucky break.
Yeah. Okay, so one of the things that O'Neill is most famous for is his CAN-SLIM system.
Uh-huh.
And this is his system for picking winning stocks. And again, it's all based on, these specific factors.
Yeah, and every letter stands for something you should be considering.
Right. So we're going to break down each letter of CAN-SLIM, but let's start with C, current quarterly earnings per share.
Okay.
And this is basically, how much profit is the company making right now?
Right now.
Compared to the same time last year.
Exactly. It's that year-over-year growth that you're really looking for.
Okay, so O'Neill says that this is like one of the most important factors to look at.
Yeah.
Because strong earnings growth is a huge predictor of future stock performance.
Absolutely. And he's got the data to back it up. Like he looked at decades worth of stock market data.
Right. And he found that like 3 out of 4 of the top performing stocks over a 40-year period had earnings increases of over 70%.
That's a huge number.
In the quarter before their prices really took off.
Like that's a really significant indicator.
Yeah. So 70% or more is what you're really looking for.
Yeah, you want to see that big jump.
Okay, but there's a catch, right?
There is. You can't just look at a company's overall revenue or net income.
Oh, okay.
You got to look specifically at the percentage increase in earnings per share.
Earnings per share.
Yeah, so for example, if a company's earnings per share jumped from like 50 cents to $1, that's a 100% increase, right?
Right.
That's a much stronger signal than if a company just like earned more profit overall, but didn't have a big change in earnings per share.
So it's not just about them making more money overall. It's about them making more money per share.
Per share, exactly.
Okay, I got it. Okay, so that's C.
Uh-huh.
What about A?
A is for annual earnings increases.
So this is looking at earnings over a longer period of time.
Right. You want to see a consistent track record of strong earnings growth.
Like year after year.
Yeah, ideally like 25 to 50% or more annually for the past 4 or 5 years.
Okay, so it's not enough for a company to just have like one good quarter.
Right.
They need to show that they can sustain that growth.
Over time.
Over time. Yeah. And I think that makes a lot of sense because like a one-hit wonder, it doesn't really tell you anything about the future.
Exactly.
So it's like
it could be a fluke.
Yeah, it could be a fluke. But if they can do it year after year after year,
then they've got something special.
Then you're like, okay, this is a company that's actually like, growing and building something.
Building a real business.
Yeah. Okay. So N is next. And this one stands for new products, new management, new highs.
Okay.
And the new products and new management part seem pretty straightforward, right?
Yeah, it's all about innovation and shaking things up.
Yeah, like are they coming out with something new? Are they bringing in new leadership?
Are they adapting to the market?
Yeah.
Are they staying ahead of the curve?
Yeah, but new highs.
That was a little counterintuitive.
That one's a little bit weird.
Yeah.
Because wouldn't a stock at a low price be a better buy?
You would think so, right?
Like seems like, oh, this is a bargain.
Yeah, it's on sale.
Yeah.
But O'Neill actually found that stocks breaking out to new highs, especially after a period of consolidation.
What does consolidation mean?
So consolidation is like when a stock is kind of trading in a range.
Okay.
It's not really going up or down significantly.
Got it.
It's just kind of like moving sideways.
Oh, okay.
And then all of a sudden it breaks out of that range to the upside. That's often a very bullish signal.
So it's like it's been building up energy.
Yeah, like it's been coiling up like a spring.
And then boom.
and then it releases.
Yeah.
And it takes off.
Okay, so you're saying it's better to ride that wave of momentum than to try to catch a falling knife.
Exactly.
Okay.
Yeah.
Yeah.
Don't try to be a hero.
Yeah.
Let the market tell you what to do.
Okay. All right. So this is starting to make sense to me.
Good.
All right. Let's move on to S, supply and demand.
Okay.
And this one seems pretty basic, right?
It is. It's basic economics.
Yeah.
But it's often overlooked in the stock market.
So what does it mean in terms of investing?
So O'Neill emphasizes looking for stocks with a smaller capitalization.
Okay.
Meaning there are fewer shares available.
Okay. So fewer shares.
Yeah.
High demand.
Higher demand.
Price goes up.
Price goes up.
Basic economics.
Exactly. It's like a rare baseball card.
Okay.
The fewer there are, the more valuable they become.
I like that analogy. Okay, so this often favors smaller companies then.
It often does, yeah. Especially like smaller, more innovative companies because they just have fewer shares floating around out there.
All right, that makes sense. What about L, leader or laggard?
Okay, so O'Neill is all about picking stocks that are leaders in their industry groups.
Okay.
And he uses a metric called relative strength to measure this.
Okay, what is relative strength?
So relative strength essentially compares a stock's performance to the overall market or to other stocks in the same sector.
Okay, so you want to choose companies that are not just doing well,
right,
but doing better than their competition.
Yes, you want the standouts. You want the ones that are really excelling.
Okay, because leaders tend to stay leaders.
Exactly. And laggards, well, they often keep lagging.
Right. That makes sense. I stands for institutional sponsorship.
Okay.
So this is where we're talking about the big players like mutual funds, pension funds.
The institutions, yeah.
Yeah, hedge funds, all that stuff.
All the big money.
Exactly. Yeah. So what's the significance of institutional sponsorship?
So O'Neill believes that having some institutional ownership in a stock can be a good sign.
Okay.
Because it means that those professional investors with their teams of analysts and all their research.
Right. They have a lot of resources.
They have a lot of resources, and they're putting their money where their mouth is.
Right. So they're saying we believe in this company.
Exactly.
Okay. But too much institutional ownership could be a problem.
It could be, yeah. Because if a stock becomes over-owned by institutions, it can be very vulnerable to big sell-offs.
Oh.
If sentiment changes.
Like if everybody's trying to get out at the same time.
Exactly. It's like a crowded theater.
Okay.
If somebody yells fire, everybody rushes for the exits at the same time.
Right. That's a good analogy. Okay, so you want to find that sweet spot.
Yeah, you want some institutional ownership, but not too much.
Got it. Okay, last but not least, we have M for market direction.
Okay.
And this seems like a really big picture concept.
It is. It's about understanding the overall trend of the market.
Because even the best stocks can struggle.
Absolutely.
If the market is crashing.
Yeah, you can't fight the tide.
Right.
You got to swim with it.
So how do you analyze market direction?
Well, O'Neill has some specific methods for doing that, which we can get into later.
Okay, sounds good.
But it's basically about looking at things like market averages, trading volume, and certain indicators.
Okay, so it's like you need a good sailor and a sturdy ship.
Yeah.
To navigate the stock market.
Exactly. You need both.
Okay, awesome.
All right.
So we've covered all the letters of CAN-SLIM.
We have.
But now the big question is...
What's that?
How do you know when to sell a stock?
Yes. The exit strategy.
Yeah, because that feels just as important as knowing when to buy.
It is absolutely crucial. And this is where a lot of investors really struggle.
Oh, why is that?
Well, emotions get in the way.
Yeah.
People get attached to their stocks. They get greedy. They get scared.
But but it's going to go back up.
Yeah, they start making decisions based on hope and fear instead of logic and data.
Right, and that can lead to some really costly mistakes.
Oh, absolutely. You can wipe out all your gains and then some if you're not careful.
So O'Neill is a big proponent of having a clear exit strategy.
Before you even buy the stock.
Before you even buy the stock.
Yeah, you got to know your exit point before you even enter the trade.
So you're saying don't get married to your stocks.
Exactly. Be willing to cut your losses and take profits when it makes sense.
Okay, so let's talk about cutting losses first.
Okay.
One of O'Neill's key principles is setting a stop-loss point.
Right.
Now, what is a stop-loss point?
So a stop-loss point is basically like a safety net.
Okay.
It's a predetermined price at which you will sell your stock if it starts to go down.
Okay.
So you're basically saying, okay, I'm willing to lose this much and no more.
Got it.
And O'Neill typically recommends setting a stop-loss around 7% or 8% below your purchase price.
Okay.
So if the stock drops below that level, you sell, no questions asked.
Ouch.
Yeah, it might sting a little, but It prevents a small loss from becoming a catastrophic one.
Right. It's like ripping off a Band-Aid.
Exactly. Better a quick pain than a long, agonizing one.
Yeah, but wouldn't that mean you can miss out on a rebound, though?
It's possible, but remember, the stop loss is there to protect you. It's about managing risk, and even the best investors get it wrong sometimes.
Really?
Oh, yeah. O'Neill himself tells this story. By the time he had, like, a string of winning picks.
Uh-huh.
But he ended up breaking even because he held on for too long and gave back all his profits.
Oh.
Yeah, he got greedy, and it cost him.
So he's speaking from experience.
He is. He's learned these lessons the hard way.
That's good to know. Okay,
Yeah.
So knowing when to sell is just as important as knowing when to buy.
Absolutely. You got to have both sides of the equation figured out.
Okay, what about the other side of the coin, taking profits?
Okay. So O'Neill generally suggests selling when a stock has risen about 20% from your purchase price,
Okay.
especially in a volatile market.
So don't get greedy.
Don't get greedy. Take your gains and run.
Okay.
It's not about trying to perfectly time the market peak.
Yeah.
It's about locking in a solid profit and then reassessing.
Okay.
If the stock dips back down, you could always buy back in.
So it's like a cycle.
Yeah, it's a strategy for consistent growth rather
Yeah.
than trying to hit home runs every time.
Okay, I like that this is making a lot of sense to me. What about mutual funds?
Okay.
A lot of people invest in those.
Yeah, they're very popular.
Yeah. Does O'Neill have any advice for mutual fund investors?
He does. He sees mutual funds as a good way to participate in the market,
Okay.
especially for people who don't have the time or expertise to pick individual stocks.
Right.
But the key, he says, is to think long term.
Okay, so like 10, 20 years down the road.
Exactly. Pick a good fund and let it grow. Don't panic and sell when the market dips.
Okay.
In fact, O'Neill suggests adding to your mutual fund holdings during bear markets.
Wait, really?
Yeah.
Buying when everybody else is selling?
That's the idea. You're buying low,
Okay.
which sets you up for bigger gains when the market eventually recovers.
So you're like zigging when everyone else is zagging.
Exactly. You're being contrarian.
Okay, I like that patience is key.
Patience is key in the market.
What should people look for when choosing a mutual fund?
So O'Neill recommends growth funds with strong track records and experienced management teams. He's not too worried about management fees.
Really?
Yeah, he believes that active management can often lead to better returns than passive index funds.
Interesting. It sounds like O'Neill's not afraid to go against the grain.
He's definitely got his own way of thinking.
Yeah. Okay, well, speaking of going against the grain, what are some common investor mistakes that he sees people making?
Okay, well, one of the biggest mistakes is letting emotions dictate your decisions.
Oh, yeah. That makes sense.
Fear and greed can lead to impulsive buying and selling, which often results in losses.
It's like that saying, buy high, sell low.
Exactly the opposite of what you want to do.
Right.
Another mistake is not doing enough research.
Oh, okay.
O'Neill stresses the importance of understanding the companies you're investing in.
Right.
Don't just buy a stock because it's a hot tip or because you recognize the company's name.
Okay.
Dig deeper and look at the fundamentals.
So knowledge is power.
Absolutely. Knowledge is power in the market.
All right. And finally, a lot of investors get caught up in the short-term noise of the market.
All right. They get distracted by the day-to-day fluctuations.
Yeah, like checking their stocks every 5 minutes.
Yeah. And freaking out over every little dip.
Right.
O'Neill emphasizes the importance of having a plan and sticking to it.
Okay.
Don't let the day-to-day ups and downs of the market derail your long-term investment goals.
So it's all about keeping your eyes on the prize.
Exactly. Focus on the long game.
Okay.
Now, there's one more piece of O'Neill's investing puzzle that we need to talk about, and it's a big one.
Oh, okay. I'm intrigued. Lay it on me.
Chart patterns.
Chart patterns.
Yeah.
Wait, like the squiggly lines that go up and down?
Those are the ones.
I think those are just for like Wall Street guys in movies.
You know, they make it seem very complicated, but charts are actually a powerful tool for understanding supply and demand dynamics.
Really?
Yeah, they tell a story about how investors are feeling and how they're reacting to a particular stock.
So it's like reading the market's body language.
Exactly. Certain patterns can signal that a stock is about to break out, while others might indicate that it's time to sell.
So it's not just about the numbers.
Yeah.
It's about understanding the psychology behind those numbers.
Exactly. O'Neill believes that chart patterns can provide valuable insights that you might miss just by looking at financial statements.
Okay.
It's like having an extra set of eyes on the market.
Wow, that's actually pretty cool. So where can people go to learn more about chart patterns?
Well, there are tons of resources available online and in libraries.
Okay.
O'Neill even has a whole section on chart patterns in his book.
Oh, perfect. So we'll definitely have to dig into that more in a future episode.
Sounds good.
All right, well, that's it for today. We've covered a lot of ground.
We have.
From the CAN-SLIM system to selling strategies to the power of chart patterns.
It's a lot to take in.
It is. It's a lot. But the key takeaway is that anyone can learn to be a successful investor.
Absolutely.
It takes time and effort and discipline, but the rewards can be significant.
They can be life-changing.
Yeah, so for anyone listening who's feeling overwhelmed, just remember, start with the basics. Do your research, and don't be afraid to ask for help.
There's no shame in asking for help.
Yeah, there are resources out there like O'Neill's book that can guide you along the way.
Absolutely, and there are plenty of people who are willing to help.
Right.
You don't have to do this alone.
All right, well said. Thanks for joining us on this deep dive into William O'Neill's investing wisdom.
It's been a pleasure.
We hope you learned something new and feel empowered to take control of your financial future.
To your financial freedom.
Yeah.
Cheers to that.
Cheers. All right, we'll see you next time.
See you next time.
It's like, you need a good sailor and a sturdy ship to navigate the stock market.
Yeah, you need both.
Speaking of navigating, how do you know when to sell a stock?
The exit strategy.
That feels just as important as knowing when to buy.
Absolutely. Knowing when to sell is crucial, and this is where a lot of investors get tripped up.
Yeah, why is that?
Emotions.
Oh, yeah.
People get greedy or scared.
Oh, it's going down, but it's going to go back up.
Exactly. They get attached. They start making decisions based on hope and fear instead of logic.
And data.
And data.
Right. And that can lead to some costly mistakes.
Oh, absolutely. Wipe out all your gains and then some if you're not careful.
So O'Neill, he says, have a clear exit strategy.
Before you even buy the stock.
Before you even buy it.
Yes, you got to know your exit point before you even enter the trade.
So don't get married to your stocks.
Exactly. Be willing to cut your losses and take profits when it makes sense.
Okay, so let's talk about cutting losses.
Okay.
What is a stop loss point?
Okay, so a stop loss point, it's like a safety net.
Okay,
It's a predetermined price where you say, okay, if it falls below this, I'm out.
Okay.
I'm willing to lose this much, but no more.
Got it.
And O'Neill, he usually recommends setting it around 7 or 8% below what you paid.
Okay.
So if it drops below that level, you sell, no questions asked.
Ouch.
It might sting a little bit, but it's better than a small loss becoming a big one.
Right, it's like ripping off a Band-Aid.
Yeah. Exactly. Quick pain rather than a long, agonizing one.
But wouldn't you miss out if it rebounds?
It's possible, but the stop loss, it's there to protect you.
Okay.
It's about managing risk. And, even the best investors, they get it wrong sometimes.
Oh, really?
O'Neill himself tells this story where he had a bunch of winning picks,
Uh-huh.
but he ended up breaking even.
Oh, no.
Because he held on too long and gave back all his profits.
They got greedy.
He got greedy. It happens.
So he's speaking from experience.
He learned those lessons the hard way.
That's good to know. So selling is just as important as buying.
You got to have both sides figured out.
Okay, so what about the other side, the taking profits side?
So O'Neill usually suggests selling when a stock has risen about 20%
Okay.
from your purchase price, especially if the market is volatile.
So don't get greedy.
Don't get greedy. Take your gains and run.
Okay.
It's not about timing the market peak perfectly.
Right.
You lock in a solid profit, reassess.
Okay.
Maybe it dips back down, you buy back in.
Because it's a cycle.
It's a strategy for consistent growth, not home runs every time.
I like that this is making a lot of sense. What about mutual funds?
Okay.
A lot of people invest in those.
They're very popular.
Does O'Neill have any advice for mutual fund investors?
He does. He sees them as a good way to participate,
Okay.
especially for people who don't have the time to pick individual stocks.
Right.
But the key, he says, is to think long term.
Okay, so like 10, 20 years down the road.
Exactly. Pick a good fund, let it grow. Don't panic, sell when the market dips.
Okay.
In fact, he suggests adding to your holdings during bear markets.
Really?
Yeah,
So buying when everyone else is selling.
that's the idea. You're buying low,
Okay.
which sets you up for bigger gains later.
So you're like zigging while everyone else is zagging.
Exactly. You're being contrarian.
Okay, I like that patience is key.
Patience is key in the market.
What should people look for when choosing a mutual fund?
He recommends growth funds with strong track records and experienced management teams.
Okay.
He's not too worried about management fees.
Oh, really?
Believes that active management can often lead to better returns.
Interesting. Sounds like he's not afraid to go against the grain.
He's got his own way of thinking.
Speaking of going against the grain, what are some common mistakes investors make?
One of the biggest, letting emotions dictate your decisions.
Oh, yeah. That makes sense.
Fear and greed lead to impulsive buying and selling, which often results in losses.
It's like buy high, sell low.
Exactly the opposite of what you want to do.
Right.
Another mistake, not doing enough research.
Oh, okay.
O'Neill stresses understand the companies you're investing in.
Right.
Don't just buy a stock because it's a hot tip or you recognize the name.
Okay.
Dig deeper. Look at the fundamentals.
So knowledge is power.
Absolutely. Knowledge is power in the market.
All right. And finally, a lot of investors, they get caught up in the short-term noise.
Right. The day-to-day fluctuation.
Yeah, just checking their stocks every 5 minutes.
Yeah, freaking out over every little dip.
Right.
O'Neill emphasizes having a plan and sticking to it. Don't let the ups and downs derail your long-term goals.
So keep your eyes on the prize.
Focus on the long game.
Okay.
Now, there's one more piece of O'Neill's puzzle we need to talk about, and it's a big one.
Oh, okay. I'm intrigued. Lay it on me.
Chart patterns.
Chart pattern.
Yeah.
Those squiggly lines that go up and down.
You got it.
I always thought that was just for, like, people on Wall Street in the movies.
It can seem intimidating.
Yeah.
I know. But charts can be a really powerful tool.
Oh, okay.
They can help you understand supply and demand.
Really?
How investors are feeling. How they're reacting to a stock.
So it's like you're saying it's like reading the market's body language.
Exactly. Certain patterns can tell you if a stock is about to take off or if it's time to sell.
Okay, so it's not just the numbers then.
Right. It's about the psychology, too.
The psychology behind the numbers.
Exactly. O'Neill believes that chart patterns can give you insights you might miss otherwise. Like you're looking at the financial statements. You might miss something, but the chart might show you something different.
So it's like having an extra set of eyes on the market.
Exactly. It's another tool in your toolbox.
Okay, well, this is fascinating. Where can people go to learn more about these chart patterns?
Well, there are lots of resources online.
Okay.
Libraries. O'Neill's book even has a whole section on them.
Perfect. So we've covered a lot today.
We have CAN SLIM selling strategies, chart patterns.
It's a lot to take in.
It is. But anyone can learn this stuff.
Anyone can learn to be a successful investor.
Yeah. With enough time, effort, and discipline,
right,
the rewards can be huge.
Life-changing even.
Absolutely.
So if anyone listening is feeling a little overwhelmed right now, remember, start with the basics.
Take it one step at a time.
Do your research. Don't be afraid to ask for help.
Yeah, there are people out there who want to help.
There are resources like O'Neill's book.
Exactly. And communities' online forums.
You don't have to do this alone.
Definitely not.
All right, well said. Well, thanks for joining us today on this deep dive into William O'Neill's Invest in Wisdom.
It's been a pleasure.
We hope you learned something and feel empowered to take control of your financial future.
To your financial freedom.
Yes! Cheers to that.
Cheers.
We'll see you next time.
See you later.